Dividend ETFs 101, Balancing Income Growth for Long-Term Success. Hey everyone, and welcome back to Chat ETF. Today, we're diving into the world of dividend ETFs, your one-stop shop for generating income while you invest. Tired of volatile markets messing with your portfolio? Want a reliable income stream to supplement your income or power your retirement? Then listen up. Dividend ETFs might be the answer you've been searching for. We'll break down everything you need to know, what they are, why you might want them, and how to choose the right ones for your portfolio. So, stick around, and let's unlock the power of dividend ETFs. Question 1. What are dividend ETFs? Dividend ETFs are investment vehicles that pool assets in companies with a history of paying out a portion of their profits to shareholders. These dividends are typically distributed quarterly and can be reinvested in the ETF for compounding growth or received as cash income. Question 2. Why choose a dividend ETF over individual stocks? Several factors make dividend ETFs attractive. 1. Diversification. Owning a single stock carries significant risk if the company underperforms. ETFs spread your investment across multiple companies, reducing concentration risk and potentially enhancing portfolio stability. 2. Convenience. Managing individual stocks can be time-consuming. ETFs offer instant diversification and rebalancing, simplifying your investment process. 3. Lower costs. Expense ratios for ETFs tend to be lower than actively managed mutual funds, potentially boosting your returns. 4. Tax efficiency. Certain dividend ETFs may qualify for preferential tax treatment, such as lower dividend tax rates. Question 3. What are the key characteristics to consider when choosing a dividend ETF? 1. Dividend yield. This metric represents the annual dividend payment per share divided by the share price, expressed as a percentage. While a high yield is attractive, a sustainable track record of dividend payments and growth is crucial. 2. Expense ratio. The annual fee charged by the ETF to cover operating costs. Lower expenses translate into higher potential returns for investors. 3. Underlying holdings. Analyze the companies included in the ETF and their dividend history, financial health, and future growth prospects. 4. Sector allocation. Consider the diversification across sectors within the ETF to avoid overexposure to specific industries. 5. Investment objective. Align your selection with your investment goals and risk tolerance. Some ETFs focus on high current income, while others prioritize long-term growth alongside dividends. Question 4. What are some top dividend ETFs for different investment objectives? High current income. 1. SPDR SP Dividend ETF. SDY tracks the SP High Yield Dividend Aristocrats Index, comprised of companies with a history of increasing dividends for at least 20 consecutive years. Offers a high average yield, but may be more sensitive to market fluctuations. 2. Global X Super Dividend ETF. SDIV invests in high-yielding companies globally, focusing on developed and emerging markets. Provides higher yield potential, but comes with increased risk associated with international markets. Balanced income and growth. 1. Vanguard High Dividend Yield ETF, VYM tracks the FTSE High Dividend Yield Index, providing exposure to large and mid-cap U.S. companies with high dividend yields. Offers a good balance between income and growth potential. 2. Schwab U.S. Dividend Equity ETF, SCHD tracks the Dow Jones U.S. Dividend Select Index, focusing on U.S. companies with a strong track record of dividend payments and quality metrics. Provides a balance between income and sustainable dividend growth. Low volatility income. 1. Invesco SP 500 High Dividend Low Volatility ETF, SPHD tracks the SP 500 Low Volatility High Dividend Index, selecting companies from the SP 500 with lower volatility and high dividend yields. Aims to provide consistent income with potentially lower risk. 2. Nuveen Quality Dividend Defense ETF, QQD focuses on high-quality U.S. companies with strong fundamentals, low volatility, and consistent dividend payments. Prioritizes income stability over high yields. Question 5. Are there any risks associated with dividend ETFs? 1. Market risk. The ETF's value can fluctuate based on overall market conditions, potentially impacting both capital appreciation and dividend payouts. 2. Interest rate risk. Rising interest rates may make fixed income alternatives more attractive, potentially leading to decreased demand for dividend-paying stocks and lower ETF prices. 3. Sector concentration. An ETF heavily weighted towards specific sectors may be more susceptible to downturns in those industries. 4. Dividend sustainability. Companies can cut or eliminate dividends, impacting the ETF's income stream and potentially its share price. Question 6. What are some alternative strategies for generating income from your investments? 1. Fixed income investments, bonds, CDS, and other fixed income instruments can provide regular income streams, but may offer lower overall returns compared to stocks. 2. Real estate investment trusts, REITs. These companies own and operate income-producing real estate, typically offering dividends that may be subject to different tax treatment than traditional stock dividends. 3. Peer-to-peer lending platforms. These platforms allow individuals to lend money directly to other individuals or businesses, potentially generating income, but carrying inherent risks. Question 7. What are some key takeaways for potential investors in dividend ETFs? 1. Dividend ETFs offer a compelling option for generating income and potentially achieving long-term capital appreciation. 2. Careful selection is crucial, considering factors like dividend yield, expense ratio, underlying holdings, and alignment with your investment objectives. 3. Diversification across various asset classes and risk management strategies are essential for a balanced and sustainable investment portfolio. 4. Seek professional guidance when needed, and consult a tax advisor to understand the specific tax implications for your situation. Question 8. How do dividend ETFs generate income? Dividend ETFs don't directly generate income themselves. Instead, they indirectly generate income by collecting dividends from the underlying companies they hold in their portfolio. These companies, which are typically established corporations with a history of paying out profits to shareholders, distribute a portion of their earnings periodically, usually on a quarterly basis. Here's how the process works here. 1. Companies pay dividends. Individual companies within the ETF distribute a portion of their profits to their shareholders, including the ETF itself, as dividends. 2. ETF collects dividends. The ETF receives the dividends from each company it holds in its portfolio. 3. ETF distributes dividends. The ETF then distributes these collected dividends to its own shareholders, typically in proportion to the number of shares each investor holds. Investors can choose to receive these dividends as cash, or reinvest them back into the ETF for potential compounding growth. Therefore, the income generated by a dividend ETF comes directly from the dividends paid by the underlying companies within the portfolio. The ETF acts as an intermediary, collecting and distributing these dividends to its shareholders. However, it's important to remember that not all companies pay dividends, and even those that do can cut or eliminate their dividends in the future due to various factors, such as economic downturns or company performance changes. Question 9. What are the advantages of investing in dividend ETFs? Investing in dividend ETFs offers several advantages for individuals seeking income, stability, and potential growth in their investment portfolios. 1. Regular income stream. Dividend ETFs provide a predictable and consistent stream of income through the regular dividend distributions from the underlying companies. This can be particularly beneficial for retirees or individuals seeking to supplement their income. 2. Diversification. Unlike holding individual stocks, dividend ETFs offer instant diversification across multiple companies within a single investment. This reduces your risk compared to putting all your eggs in one basket, as a single company's underperformance has a lesser impact on the overall portfolio. 3. Convenience and ease of management. ETFs offer a convenient and cost-effective way to invest in dividend-paying companies. You don't need to research and select individual stocks, eliminating the time and effort involved in managing a portfolio of individual holdings. 4. Potential for capital appreciation. While the primary focus of dividend ETFs is on income generation, they also have the potential for capital appreciation over the long term. The value of the ETF, like any other investment, can fluctuate based on market conditions, but the underlying companies may also experience stock price growth, leading to potential capital gains alongside the dividend income. 5. Tax benefits. In some cases, qualified dividends from dividend ETFs may be taxed at lower rates compared to ordinary income. This can be a significant advantage, particularly for investors in higher tax brackets. 6. Lower costs. Dividend ETFs typically have lower expense ratios compared to actively managed mutual funds. This translates to potentially higher returns for investors, as lower fees leave more room for growth. 7. Professional management. Many dividend ETFs are passively managed, meaning they track a specific index. This offers investors a cost-effective way to access professional portfolio management, as the underlying holdings and allocations are determined by the index methodology. Question 10. Are dividend ETFs suitable for all investors? Dividend ETFs are not suitable for all investors, and their suitability depends on individual circumstances and investment goals. Here's a breakdown of who might benefit most from dividend ETFs, and who might want to consider alternative investment options here. Suitable for 1. Income-oriented investors. Retirees or individuals seeking regular income to supplement their primary income sources can benefit significantly from the predictable dividend payouts offered by dividend ETFs. 2. Risk-averse investors. The diversification offered by dividend ETFs can help mitigate risk compared to holding individual stocks. This can be appealing to investors with a lower risk tolerance. 3. Long-term investors. While dividend ETFs may not outperform the broader market in all periods, they can be a suitable long-term investment for individuals with a longer time horizon who can benefit from potential compounding of dividends and capital appreciation alongside the income stream. May not be suitable for 1. Growth-oriented investors. Investors primarily focused on maximizing capital appreciation might find that dividend ETFs, with their emphasis on income generation, underperform compared to growth-oriented investment options. 2. Young investors with long investment horizons. Young investors with a long investment time horizon may find that growth-oriented investments have the potential for higher overall returns compared to dividend ETFs over the long term. 3. Investors seeking high total returns. While dividend ETFs offer a combination of income and capital appreciation potential, they may not be the best option for investors seeking the absolute highest possible returns. Other investment strategies, such as investing in growth stocks or actively managed funds, may offer the potential for higher returns, but also come with greater risk. Question 11. How can investors choose the right dividend ETF for their portfolio? Here's a step-by-step approach to guide investors in selecting the right dividend ETFs for their portfolios. 1. Define your investment goals. Income focus. Determine how much regular income you expect to generate from your dividend ETF investments. Are you prioritizing high immediate income, or are you open to lower current income in exchange for the potential of higher dividend growth over time? Risk tolerance. Evaluate your comfort level with market fluctuations. ETFs focused on higher current income may be more volatile, while those prioritizing dividend stability can be less susceptible to major market swings. Time horizon. Consider how long you plan to hold your investment. Longer holding periods allow greater time for compounding of reinvested dividends and potential capital appreciation. 2. Analyze ETF characteristics. Yield. Understand the average dividend yield of the ETF. Remember, high yields don't always equal the best investment, and sustainability of the dividend is crucial. Expense ratio. Choose ETFs with lower expense ratios as these fees directly impact your returns. Index methodology. Examine the index the ETF tracks and its selection criteria. This dictates the types of companies included in the ETF. Sector allocation. Consider the ETF's sector diversification. Are you comfortable with being invested heavily in specific sectors, or do you prefer broader diversification? Historical performance. While past performance doesn't guarantee future results, review the ETF's track record of dividend payments, income growth, and total returns. 3. Research the underlying holdings. Sustainability. Look into the holdings of the ETF. Do the individual companies have a history of consistent dividend growth and healthy financial metrics? Diversity. Ensure the ETF provides adequate diversification and avoids overconcentration in specific companies or sectors. 4. Consider overall portfolio balance. Risk. Determine if the risk profile of the dividend ETF complements or potentially increases the overall volatility of your portfolio. Asset allocation. Analyze whether the ETF aligns with your desired asset allocation across stocks, bonds, and other investment classes. Alright folks, that's all we have time for today on dividend ETFs. Remember, dividend ETFs can be a powerful tool for generating income and building wealth, but they're not a one-size-fits-all solution. In the meantime, be sure to like and subscribe for more ETF insights and investment strategies. And if you have any questions about dividend ETFs, leave a comment below, and we'll do our best to answer them. Thanks for joining us, and happy investing.